It's all yours.
Thank you, Eric, and also thank you to all of you at Bridge for hosting us tonight in this magnificent space. This is absolutely beautiful. Can I work here? Thank you. I'd like to. So look, angel investing has really evolved quite a bit over the years. Which used to be the province of your rich uncle who was a dentist. Does anyone have a rich uncle who's a dentist? Okay. I actually have an uncle who's a dentist. Has really moved to sort of the professional angel. So let me just start maybe with you, Jason. How, in your view, has the role of an angel investor changed and evolved over the last 10 years?
Sure, Jeff. Thanks very much, and I'm very happy to be here. I think it's changed quite a bit. The competitive set has changed in terms of the VCs that are also investing alongside angels, as well as just the number of people that are basically doing this. 10 years ago, seed VCs did about about 1.3 billion in investing, and angels did 1.5. And you roll the clock forward, seed VCs are doing $14 billion in investing, and angels do about 3. So they've both grown quite a bit, but the universe has really changed in terms of who we're competing with for deals. And also, since crowdfunding has come in, and particularly COVID has kind of eliminated some of the geographic boundaries, there's a lot more people that are able to do angel investing. I don't know if I really call it crowdfunding kind of angel investing. It's kind of legalized gambling, as far as I'm concerned. Angel investing may be a little bit of the same, who knows. But there's a real difference between, I think, people that are in active angel groups that look at this somewhat methodically, and people that are just doing one or two kinds of investment. And so groups like Sandy runs, I'm also president of the Harvard Business School Alumni Angels Association. We've got 16 chapters, and we try to promote organized angel investing, and I'm also active in New York Angels, which is a big group here in New York, and that group is really pretty methodical. And when you're in a group like this, what you learn about kind of deal flow and valuation and deal terms, I mean, essentially the groups have typically got the kind of experience that most VCs have. And you see it's a very different world from being kind of a mom and pop angel investor to being a disciplined investor in a serious angel group. And I think the biggest change, I think the gap between those two has just gotten so wide over the course of this period, particularly with valuations taking off in the past couple of years.
Great. Sandy, I'd love to give your opinion.
Thanks very much, and it's thank you for having me and being on such a prestigious panel. So a real honor. Thank you. Jason touched on valuations, and I think that's the one thing. And I'm the new guy on the block here. I've been in the angel space for about 6 years. But one of the things I've learned is valuations are before up until a couple months ago, been really crazy. Just tell you a really funny story. I was referred to a startup in Canada that was researching getting molecules out of kelp that are found in the cannabis plant, right? This is Mr. Cannabis over here. And I go, oh, okay, I get it, right? That's pretty interesting. So what kind of revenue do you have? They go, oh, we don't care about revenue. What do you mean you don't care about revenue? Well, we're a think tank, and we're raising $10 million on this $75 million valuation. So I said, are you guys smoking that kelp? I mean, maybe you shouldn't smoke the kelp. I mean, maybe, I don't get that. So valuations, everybody on the panel will tell you, that's the football, that's the fun part of being an angel, is negotiating that back and forth. But the one thing I've learned is all the angel group leaders in New York, it's a collaborative space. I'm having so much fun. It's not competition, it's collaboration. We lead an initiative that brings all the angel group leaders together for monthly deal flow calls. And when this becomes work, I'll find something else to do, but I'm having a lot of fun being an angel group leader. Thank you, Jeff.
Great. All right, so look, Jason, you mentioned syndicates, right? Groups. So there are a lot of ways to do it. You can be a go-it-aloner, right? You can join, a group like Sandy's, which is regionally focused in Westchester. There's all kinds of, what do you think, this really is for anybody, and even some of these angel groups have side-by-side funds that are committed capital. What do you think the pros and cons of each of these sort of methods of angel investing are? All right, no one wants to bite, I'm gonna have to call on somebody. Ed, let's start with you on the fun side.
You're gonna ask my father about the syndicate, okay.
Mr. Godfather.
Yeah. Well, I like what I like about Sandy and Jeff were just talking about the development of the angels beyond the uncle dentist who was funding friends. They're still out there. The uncle dentist that sees the odd deal flow, sort of rifle shot deals coming across, and doesn't really have a good sense of what else is out there, what's been tried before, competitors. Maybe they're getting a Me-Too company through the door, they don't even know that. What I like about the developments in angel investing, and it's really developments of angel as an investment class, with the syndicates and the affinity groups and the micro funds and the angel groups, is that it drives engagement. And with engagement, people come together and they can pool their talents, their capital, their expertise, their networks, their relationships, and you end up having a lot more success. We're going to talk a little bit about angel returns, and I don't want to go down that rabbit hole right now, but a lot of the returns are driven by few companies in the angel investment class. So one of the keys to getting a decent IRR is making sure that you've got a diverse portfolio. And that comes largely by having a broader relationship network. So Harvard Business Angels, Westchester Angels, Jeff is the founder of ArcView, which is as Sandy mentioned, a cannabis fund. I'm a co-founder of 3 small funds, Angel Run Capital, Reitler Opportunity Capital, and Female Founders Fund. And all of them have the same, they share some benefits that I think are really important for success in angel investing, which is that you get out beyond your own personal network. You're not just seeing things that are coming into you on a passive basis. You're out there, you have a website, you go to events, you market yourself, you market your group, you talk about your portfolio companies, you put out things in social media, and that drives deal flow. And then the ability to evaluate the deal flow with a greater team. You can pull people from your organization. Oh, this person was a dentist. We're looking at a dental tech company, which Rock recently invested in. So those are the developments that I think are really healthy for the angel class, helping drive better returns. And as we'll talk about in a few minutes, the returns in the angel class actually have outpaced venture. Not by much, but surprisingly, they have.
I'll take a stab. So, if you're an angel investor, and you're not part of an angel group, you're going to do due diligence on your own. And I'm not smart enough to do due diligence on my own. The benefit of being in an angel group is you don't have to do the due diligence on your own. You're with like-minded professionals that have different backgrounds. The more diverse the due diligence effort, the better the due diligence. So, in New York City is a thriving angel community. There's probably 25 angel groups. Jason, certainly one of the largest by population. But you could find the angel group that works for you. We all do the same thing. We all have an online platform. We screen, there's an investor meeting, there's due diligence, a document review. We all follow the same protocol, but with our own personality and spin. So if you're from Venus, you could join the Golden Seeds, or you could join the 37 Angels. If you're part of the LGBTQ community, you could join the Gangels. The Gangels have blasted off into outer space. I don't even know what to call them. They invested like $500 million last year. You could find an angel group that has a temperament that matches what you want to do. So if you're an individual angel and you want to be investing, if you're an accredited investor, of course, check out all the angel groups in the city. And if you want leads to, I know them all personally. We all share our toys in the sandbox. And not only that, there's 100 accelerators and incubators in Manhattan alone, providing a constant feeding mechanism. It's a really great space. And most angels, you get to form friendships with people in different communities. It's a really very fun space.
I mean, I'll just add, I think that's all correct. I'll just add real quick that, you know, the advantage of being in kind of a syndicate or some kind of angel network is first you get a ton more deal flow. And if there's one thing that amazes me is how I typically don't see an idea once, I typically see it 3 times. And that second and third time, even though it may be pretty innovative to someone who's not in an angel group, by the time you've seen it a third time, it's looking pretty stale, and you realize that if I've seen it 3 times, you know, there's probably another 10 or 20 that I haven't seen. So you get lots more deal flow. And then, I mean, I like to think about, you know, data. And so if you go back, I think it's in the Kaufman report, that if you do serious diligence, you tend to get exits that are about 1 to 2 times higher or 3 times higher than people that don't do diligence. And they found that 20 hours of diligence is what's required to kind of get those kinds of numbers. So what individual is going to do 20 hours of diligence? I mean, some might, but certainly if you're part of an angel group, as Sandy said, and you're relying on your peers that may have expertise in areas that you don't, there's real advantages to what you can uncover in the diligence process. And so, as I said before, being in an angel group that really does its homework and does its job, it is very different from investing as an individual angel.
So look, I want to get to Somak and Harris and talk about how they interact with angels. But before I do, I just want to stay on one part of this. Because in addition to being a go-it-aloner or joining a syndicate, there are also these hybrid funds. And certainly Ed is involved with the Archangel Fund. I was part of that early on. As part of ArcView, I run the ArcView Collective Fund, and it's a member-managed venture fund. It's the notion of bringing individual angels together in a fund format that facilitates collaborative decision-making, where everybody has a say in a vote, but they don't vote on behalf of their own pocket, they vote on behalf of the treasury of the fund. So Ed, how do you think that model holds up to sort of the loosely formed syndicates or the go-it-aloners?
It's an interesting question. We started ARC a dozen years ago with that very much as mind as an experiment. Whether a group of people could come together and be successful in making decisions in terms of sourcing. We talked about deal flow, and you know, and another thing in that same report that Jeff mentioned is not just due diligence, but it's the mentoring of the founders that also helps drive angel returns. But the returns for the sort of collaborative, collective decision making, I think are coming in. I think with ArcView's member fund and Angel Round Capital as well. It took us a while to get going in ARC 1. I think we let a few dogs go through that we all knew were dogs, that we thought, well, we're all voting on it. Let's just see what happens. And it wasn't until we started curating it wasn't until we started curating the companies a little bit more. And really trying to use a collective experience of the group that we started to succeed. And Fund 2, that we're just talking about, and the trade right up here, is doing fantastic. It's just really off the charts. And we just launched Fund 3 and just made our first investment about 2 weeks ago. So we hope we can continue the momentum. But I think what Jeff was saying earlier, which is when you get a group of people together that learn how to work together, and often those groups are in smaller funds, 4 or 5 people, but in the case of ARC and ArcView, they're 75 people, but they really maybe get 30 or 40 who are active, the rest are fairly passive. But once you get a group together that learns to work together well, the results are it can really drive good returns.
And we certainly both know there are challenges with managing that model as well.
Oh, yeah.
All right, so look, so many entrepreneurs scratch their head when they go to an angel, and the angel says, "You're too early for me." Right? Because I think angel investing means investing early, at the pre-seed or the seed stage. That's not really the case anymore. You're seeing angels pop up at early growth and growth. So Somak, you've been an institutional investor for, 20 years? How has your interaction with angels changed over that period of time as an institutional investor? And Harris, afterwards, give your view as well. How do you kind of view them as a partner in a round, how do you sort of look at a company coming to you and looking at 20 or 30 angels on the cap table, and now you're coming in as a professional institutional, leading a Series A? How does it all feel to you?
Can you hear me, guys? Well, thank you for that question. And thank you, Harris and Eric and the team here for hosting this beautiful office, and to the Reitler team for putting this event together. I have a huge debt of gratitude to you all for making this happen. So in terms of angels, angels are a critical part of our community and have been key feeders to us in terms of our entrepreneurial deal flow. So when you look at the most important, like when you look at our most successful investments ever, chances are that we got to those companies because of angels who, in many cases, are actually LPs in the fund. And when you look as a VC, we pride ourselves in having domain expertise in B2B software, in markets like digital health, auto tech. But the reality is that when a CEO is starting her or his business, of course they want to talk to VCs, but they especially want to talk to someone who's built a business in that industry. And so, you all, actually a few of you were investors in ACB with us. The way we got to that investment was through two angels. Eric Reich, who started Campus Labs, a very successful ed tech business that sold for 9 figures multiple times. And he was an early angel. And then George Shamoon, who took a company called Cynic Republic, he was an angel. And when I said, okay, these guys don't write checks for everyone. When they're going to actually spend the time to mentor an entrepreneur, whatever size check they are, if they're going to be involved in some way, that's a big deal. And so we actively find ways to partner with angels, and we think of them as key partners in the journey. They're not going to necessarily be able to, well, some angels have the ability to keep following on over and over again. But we know that no matter how small their investment is, they're going to play a critical role in the cap table and help the company through all stages of the journey. So we think that's important. And your earlier question about how that's changed over the last 10 years, I think there's just a lot more of a blurry line now, as you were saying, Jason, between angel and seed funds and Series A funds. From our perspective, we generally are doing a bit more in sort of post-seed, early A rounds. When we get involved in a pre-revenue company, though, actually, I'm looking at a company right now, earlier today in Irvington, New York, of all places. The only reason we would do that is because that entrepreneurial team is someone we've backed before, has built or done that. But the angels play a key role in mentoring the company, nurturing them, and getting them ready for the Series A. And oftentimes they'll even ask us, Somak or any other VC, what are going to be the key milestones for you to invest? So when we're writing our check, we know that there's a chance of a follow-on round. So we work very closely together.
I think our experience is fairly similar. I see the angels have been invaluable bringing us deals, and I don't think we have any deals that we've really looked at that have been meaningful that haven't somehow come from an angel, individual or a group. So it is a critical, the problem I've had is there's still a lot of the dentists that call us, and some of those are great, and they're calling themselves angels now. So I think the problem is, differentiating who is actually professional and who is still the dentist.
Right, so there's a few kinds.
No offense to any dentists.
So there's a few kinds. Let's call them the journeyman angel, the professional angel, Sandy, Jason, that have a shingle out that says I'm an angel. But there's also a strategic angel, right? There's somebody that comes from the domain space that can either serve as validation, like when you're looking at an early stage deal, you're seeing two investors that have brought companies to exit that maybe in the domain space or near the domain space. It serves not only as lead gen, but validation for you that they've written a check and have visibility into these entrepreneurs. So that's helpful. But when the role of a strategic angel as you start to invest up the cap stack into Series A and Series B, do you invite their participation at that point?
The angels into the later rounds?
Yeah.
Well, in our experience, this, a good CEO, she or he is leading the charge in terms of who they want on the cap table, right? So if an angel is delivering value, and this is, by the way, true as a venture fund, right? When we were investing in earlier funds, we were much smaller, and so we would not be the biggest venture fund on the cap table, far from it. But if you're going to work your ass off to really help the entrepreneur, that individual, that CEO will say, I know, Bessemer, General Catalyst, XYZ fund, you want to write $10 million check, but this individual actually rolled up their sleeves, and it means a lot to them wherever you are in terms of outcome. So that's important. And so I think a good angel, if they're helpful, will have that opportunity. The problem, of course, and maybe have seen this yourself, is that it's rare for angels. I mean, I know it sounds like, Harris, you are in a different camp, like you're writing bigger checks. But it's rare for most angels to get pro rata rights. That's a critical thing, right? We're not going to write a check if we don't have pro rata rights. If anything, we're looking for super pro rata. So, you know, there's obviously going to be some sharp elbow situations, but if an angel has proven his or her value, I've often told my entrepreneur, make space for her or him, because they're worth their weight in gold, right? But it doesn't always happen.
Yeah. I mean, Harris, you've been an entrepreneur, you've been an LP, you've been a GP, you're now involved with the family office. I mean, what do you think? How do you invite angels? How welcoming are you to angels to sort of stay with the company as the company raises successor rounds?
I mean, I think there's nothing more frustrating than somebody that feels they belong in the next round just because they made the introduction. I think, as you said, people that have worked their ass off to bring a great opportunity, they should come along for the ride, and we want to add on, and everybody else should add on. But the problem I've had are people that come with 37 ideas, throw them at me and say, hey, pick them, and if I pick them, then they come back and say, gosh, I should either get a fee or let me come along with you for the ride. So if it's value add, just like anything else, I think the angels are critical because they're validating the base premise of whatever it is we're investing in. But if it's nothing more than, hey, we found something great because I was at the train station and I overheard somebody, probably not a great person that we want to invite to the second round.
Yeah, understood.
One more thing I would just add is just...
We met at the train
It's true. One thing you brought up the issue about angel funds versus angel groups. I mean, no offense to people who are angel networks, but I think, your point, Harris, about the dentist, like, it could be very valuable. Actually, at the early stages, money, wherever it is like, very important, right? But the thing is that I often caution my entrepreneurs, like, if we're looking to fill out a round and we have, say, a value-add angel or a family office in healthcare, that's important. But if they have to go through 5 rounds of diligence and 2 meetings, like, the world, even as the market's going through a correction right now, time is the most valuable asset for the entrepreneur. So if they have to go through a federation of angels and go through 3 rounds of meetings and maybe hear back in 90 days, those days are long and over. In a competitive situation, you have to act immediately, and that's where I think a bunch of angel groups sometimes get into. They have a challenge. They create a challenge for the entrepreneur.
All right, shifting gears. Let's talk about performance of angel groups versus traditionally professionally managed funds. Ed, I've got a lot of papers in front of me, so I know you're prepared for this question. Ed, so tell us a little bit about sort of sort of how angels have stacked up against their professional brethren.
But the Kaufman, does everyone here heard of the Kaufman Foundation? It's a foundation that really puts a lot of money into education and many charitable causes, but in particular, they are interested in entrepreneurship. And they are also a major LP of venture funds across the country and have many direct investments as well. So they had some 100 venture fund positions, and they looked at them, and they saw some really interesting things in the data. They put out a report called "We've Met the Enemy and the Enemy Is Us," in that they saw that the venture funds that they were invested in that were over $500 million in commitments tended to perform less well than the smaller ones. And we can all speculate as to why. I mean, the smaller funds are more aligned with their LPs perhaps because they're not making their money on management fees, but rather on carry. And Armory Square Ventures is a poster child for that. Armory Square One, I tell everyone I know because it's such a spectacular number. I can't say it?
No, I said 8 years.
It's 7.9 DPI, and he's still got a tremendous portfolio sitting there. And the fund's, 7 years old, 8 years old now. So I've never heard of a fund that has 7.9. I'm sure they're out there somewhere, but that's just remarkable. But it comes when the teams are properly motivated. And so that was sort of the large takeaway that many people had from their first report. A few years later, they commissioned a couple academics to do a study of angel investing. They did this massive survey of angel investors and the returns. Now, some of it may have been self-selective. Maybe the angels were exaggerating or bragging or not reporting their dogs. It's probably less systemic than being able to measure their own portfolio of venture fund positions, LP positions. But what they came out with was pretty spectacular returns, showing, and the apples to apples are, the IRR they were showing for angel groups over the last 3 years was 27%, which is fantastic. And while venture as a whole class, it's hard to paint venture as one class because there are many subclasses of venture, from growth equity to Series A to seed. But venture as a class was at 25% IRR. And why might that be if venture is really sort of similar in terms of returns? I think that largely the thinking and takeaway from that is that a lot of the angel returns are concentrated in a few massive, 1,000x returns. I mean, the angel investments in Meta and Alphabet and other sort of real Palantir just brought spectacular returns that brings the whole industry up. And the takeaway for me as an angel investor, as a fund manager, is you're going to have so many zeros as an angel investor. You've got to have a diverse portfolio. You're banking on a TAM, total addressable market, and scalable businesses that give you a chance at a 10x. You need enough, times at bat, bullets in the chamber, whatever metaphor you want to use. You need enough times at bat to get that chance at a black swan. In the case of Armory Square Ventures and Somak, that was ACV, the company he mentioned, which IPO'd. And he did that because he had a diverse portfolio. You never know which. Sometimes you have a feeling. A lot of times that feeling's wrong. But if you have a diverse portfolio, you give yourself a shot at enough opportunities to have that big, if not 10, 20, 30x, or if you go public. And in order to do that, it really is helpful, as we said earlier, to be part of a group or part of a micro fund, an angel fund. There are many of them. There's some represented here. There's Tribeca Angels. There's a ton of them out there. And based on what you're interested in, what your affinity is, maybe if you're a Harvard alum, maybe if you're a Westchester resident, or in the case of Angel Run Capital, maybe you want to manage your own fund. You like the ability to participate, have access to deals. Or Tribeca Angels is a fintech group, or Female Founders Fund, which is obviously investing in women-led businesses. Whatever your interest is, whatever leads you to engage with that group, the most important thing, I think, if you want to make money in this business, is getting a broad enough group of deal flow, companies coming in, and then having a big enough portfolio to give yourself a chance to hit those big 10x and more.
So diversification is key. Interesting to those numbers, I also read that the difference between the funds that are in the top quartile versus the top 10%, it's not that the distribution is different. Out of 10 investments, there were one grand slam and a lot of triples and a lot of zeros. It's just that grand slam was a huge grand slam. It was a 200x versus a 25x, and that's the difference between the top quartile and the top 10%. So, all right, it's not easy work. Sandy, you run a group. I don't know how many people in Westchester Angels now. I mean, Jason, HBS Angels is enormous. I know Angel Round Capital is about 70. I have about 78 in my fund. It's hard to manage these funds. Sandy, you've complained to me on the phone numerous times. So it's hard to manage them. But what are what's key is engagement, right? Continued engagement. So what are the best practices? What have you found that's worked in keeping your group engaged?
I think, thanks, Jeffrey. Every angel group leader has the same challenge. We have 51 and a half members right now. What's a half a member? What's a half?
What's a half member?
I'm glad you asked that question. We have a member that wrote a check out 3 months ago, but never signed our membership form. So he's a half a member. So anyway, yeah, and I've called him. I just hope he's okay, and there's no harm done to the family. But most angel group leaders have the same challenge. It's our responsibility is to find accredited investors that want to participate and get really good deal flow. There are very few professional angel investors that do this for a living. Outside, Jeffrey, some distinguished panelists here. Some are retired and they want to do something with their time. A lot of angels in our group have pretty successful businesses, So angel investing to a lot of people, it's a fancy conversation. So, you know, while we want to get new members, it's really about participation. You know, in order to do the due diligence properly, you know, we don't write 15-page reports. We believe business is about people. So we want our startups to be located in the area so they can pitch to us in person. And then after all of our meetings, we have a schmooze session with food and drink, and it allows the startup a rare opportunity to talk to investors in a relaxed atmosphere. That's very rare in the angel space because startups always have to be on. So the biggest challenge is to get people to participate their time. Now, we record everything, so if you can't make it, you know, there's a recording. We're very careful about the recordings. But what we're doing at the Westchester Angels is we're trying to create a little FOMO. And I think we're pioneers in the whole country. And I know this because Pat was talking about it.
We hear that.
Yeah, I was just named to the Angel Capital Association Board of Directors, so I have a feel of what's going on across the country. So Jason, I told you if you want to get a hold of me, now I have people. Get a hold of people. Anyway, we have our events at different locations. Most angel groups have their meetings at a shared workspace, an attorney's office, a banquet room. We have ours at different locations throughout Westchester. Art galleries, the J. Heritage Center, a building built in 1838. We had a meeting at the Captain Lawrence Brewery down the road surrounded by vats of beer. Last week we had our huge first inaugural Garcia's investor meeting. We had 85 people show up to Garcia's Bar, which is attached to the Capitol Theater in Portchester. We had my friend's band played, and the only reason I did is because I want to get on the stage and play my friend's band. We had a tour of the Capitol Theater. So we're doing things a little differently. A lot of angel groups in the city are very focused on investing, very business-like, and that's okay. That's their temperament. We're serious about investing, but we want to have fun along the way. So that's why we have it at different venues to get people to come out and participate, and that's how we're doing it.
So you're creating experiences really for them.
Experiences. Again, we're serious about investing. We do a lot of due diligence. You know, these are risky investments. You shouldn't be playing with house money. That's why you should be an accredited investor. You have to be an accredited investor. But we're trying to create a model where we're having fun along the way. Our members get to form friendships, and again, it allows the startups a rare opportunity to talk to investors over a beer.
So I'll just offer how we do it. I mean, we run 2 meetings a month. One's an evaluation committee meeting that vets the first group and advances 2 or 3 companies to a full members meeting. But each full members meeting, we have a speaker for the first 15 minutes that serves to educate on a topic, so that people come to get educated, not only to hear compelling companies, some of which will make it, some of which won't, but to sort of learn something from the speaker in the aggregate group. Jason or Ed, anything to add to sort of how you keep engagement going?
Sure, I'll note. So, Harvard Business School of Dumb Angels, we have 16 chapters. And so it's an interesting experiment to see which ones have kind of gelled and grown and which ones haven't. And you know, part of the difference, there's some of the obvious factors about just energizing volunteers, and some groups are better at doing that than others. But the other key factor is that we have many chapters where the entrepreneur comes in and pitches, and at the end of the pitch they say, if you're interested in the company, here's the entrepreneur's phone number and email address. You contact him directly and you work it out with him. And there's no engagement after the pitch. On the other hand, in New York, what we do is not only do we people are making their own decisions. So everyone is investing on their own. That's always going to be the case. We don't have a fund because legally that's just too complicated for us. People are still investing on their own, but we look at the deals collectively. But then also, once the deal is made, we'll appoint a lead investor that maintains a relationship with the company. We keep track of their news and developments, and then if there's a follow-on round, we'll be organized in terms of looking at the round and doing the investment. And also we have a very organized mentor process. So if the CEO of one of our companies has an issue, they call up someone who we actually call the chief mentor, and they can access a database of all of our members and match them with a member that may be able to help them. in a particular area. So it really is, the check is basically, it's the beginning of a relationship that really lasts through the course of that company's existence, and maybe will end when the company exits happily. And that leads to just continual engagement within the group. It's very much along a VC fund model, but not every angel group is able to maintain that kind of discipline and build that kind of engagement throughout the company's life cycle.
We're a little bit different at ARC in that it's a fund. So even though it's like an angel group and that angels have come together to commit a fund, at ARC, we all participate in managing the one fund, much like ARC and Just Fund. So the way we try and generate engagement and have for the last dozen years is to allow people to go to work on the evaluation committee, the executive committee, due diligence committees, monitoring committees, and get involved with the company. Some of them ended up taking jobs with the companies and becoming consultants or board members. And it's that type of engagement that people in ARC really seem to enjoy. And rather than just being a passive LP and having your money managed for you, ARC allows you to be a participant in a collective with a group managing all of your money together. And that seems to get people out and engaged.
Yeah, sort of like participation with a safety net, in a way, right? So look, we've established that angels aren't just investing early, but there's a lot of activity at seed and early growth and even pre-seed. I want to just maybe address this to Harris and maybe Somak. What are you seeing out there in terms of the supply and demand imbalance between issuers, companies raising money at pre-seed, seed, or early growth, and the availability of capital to support those deals?
Yeah, it's interesting. So although there's been a lot of capital flowing into venture capital over the last 5-6 years, like there's more. Yeah, I definitely think, if anything, I think you'll hear from a lot of VCs that there's too much capital sloshing around. I think if you peel the onion, you see where that capital is allocated. The vast majority is at the growth stage, companies raising $100 million plus rounds. So what we see in general is that although there's a lot of capital in aggregate in venture capital, when you look at the actual capital that's available at the seed and early A, and then if you also then qualify further and say, who are the funds that are actually leading rounds, that don't need the social validation of 10 other of their buddies, like who are venture funds all coming in. There's a lot of people who are willing to follow, but people who are willing to lead and actually taking risk, that's a very, very small amount of capital. So actually, I would say that there needs to be more investors, in addition to complement the existing angels, who are interested in leading seed rounds, rolling up their sleeves, taking board seats, really doing the heavy lifting. And we find that, if anything, we see as many more of our funds have become successful, they've become more focused on AUM and building large platforms. I can't tell you the number of funds in New York without naming names who said, we will never raise a fund above 100, 250 million. And then I'm looking at, they just raised $1 billion fund. When you raise $1 billion fund, if you raise even a $500 million fund, this goes to Ed's earlier point from the Kaufman report, you can't do seed checks. I mean, even if you did do $1 million, $2 million, you're really just creating a small option, and you're really focusing on where you can deploy 10, 50, or 100 million and above. And so I think there's still a lot more opportunity for both angels and funds who lead proper rounds. We don't see, it's a pretty lonely area that we invest in.
I couldn't agree more. I mean, there's more seed and early growth opportunity now than I've ever seen, even though everybody's saying that there's more money in the market. The way that I sort of check that is the number of repeat phone calls we get from people when we say we're not sure. You would assume that they're going to speak to the 12 other people they told us about, yet they keep calling us. So I've in the last couple of years, even though everybody is saying that there's tons and tons of money, even the great companies that are out there, they keep coming back. So I don't know what that says about the market. I don't know what it says about the funds. I agree with you on the lead side. There's not many people that want to lead. Everybody's happy to be number 2, 3, 4, 5. But again, it's unlimited right now.
Yeah, so you suspect that there's really not enough money for these deals?
Well, if you're raising 50 or $100 million, there's a
Yeah,
lot of money
I'm
out
talking
there.
about the 750 to $1.5 million.
That's where the dentists are coming back in.
God bless those dentists. All right, so what about crowdfunding? Right, so crowdfunding, how has it impacted the landscape for seed and early growth? This is to anybody, anyone has a perspective.
Yeah, I think we're still seeing this as a developing area. It was crowdfunding was part of the Jobs Act during the Obama administration, one of the few bipartisan pieces of legislation that was passed in the last 6 years of that administration. And yeah, I think the idea was sound, which was to make venture and angel investments accessible to a broader range of people, that you could do these non-accredited investors could have a shot at it, accredited investors that could have more access to deal flow outside of venture funds. And the thought originally was that it was going to disintermediate, the middleman, in this case, venture fund general partners, and that there would be this direct market to venture stage companies. But as a practical matter, I can't remember whether it was Sandy or Jeff or Somak who said it earlier, you just can't do due diligence on a crowdfunding opportunity. I mean, there's some nice platforms out there, AngelList, Seed Invest, that give you information about the company. There's a brief white paper or PPM. But I've found over the years as an attorney and as an investor that it's crowdfunding tends to be the equity funding of last resort. If venture stage companies can't get smart money from the VCs, they'll tend to move on to individuals or to crowdfunding platforms. And there are exceptions every rule. There's some very successful crowdfunding companies, and I don't mean to say it's a kiss of death if you come across a crowdfunding company that you're interested in, but it hasn't yet threatened the VC model. We hosted an event called VCs on Skis, where we had a very engaging cryptocurrency speaker named Melton Demers. Somak, I think you were at that event.
I was just about to reference it, so if you can start,
Yeah.
I was going to.
And she to a room full of VCs, she wore a hoodie that said "VC is dead" to begin her speech to the group. So she was getting off to a rousing start. But her thesis was that VCs are dinosaurs that need to get out of the way and let capital have direct access to these terrific entrepreneurs that were somehow, these middlemen were siphoning fees off of the capital going in. And I think that hasn't happened. The VCs still perform, it's a service business, venture capital. They still perform the very valuable services of due diligence, deal execution, deal monitoring. And you really have to stay on top of these companies. There's a lot of, even when you invest in a good company, there's a lot of things that can go wrong. You can get squashed by subsequent investors. And you really need somebody who knows what they're doing and able to protect themselves and the round that they've invested in from a legal standpoint. So I think crowdfunding is going to continue to evolve. I'm curious to see how it goes, but for now, it's still sort of on the fringes.
And that's the benefit of a panel, because you can ask 7 different investors, you get 8 opinions, and that's an important part of angel investing. My take on crowdfunding, I'm not a big fan of crowdfunding. I think it's a double-edged sword. I don't think the people that are writing the checks out understand the true risk. You should not be playing with house money. You should be investing money you can afford to lose. And a lot of people that crowdfund are looking for a big ticket that may never come. And for the startups point of view, you don't get the angel, angels not only write checks out, but we help. We give good Rolodex, we do whatever we can to help the startup succeed. So if they're going to crowdfund, they're going to lose that extra help. And on the other side, again, if you're writing a check as an investor, you're not understanding the people that are running the company. Business is 100% about people. Steve Jobs didn't create Apple by himself. He surrounded himself with good people. And that's why when we're in due diligence, we're primarily kicking the tires of the founders and the team. We primarily invest in good people with a really good idea, a chance to scale. We will not invest in a great idea with a bad team. And that's the one thing that crowdfunding lacks. It's very impersonal. And I don't know if a lot of the websites educate the people that are writing checks out as to the risk of crowdfunding.
So I'm gonna be the ninth opinion, I guess, because we said 7, there's 8 opinions. Okay. So I think there's utility. So first of all, some companies are doing Reg D, traditional financings, alongside of CF financing, crowdfunding, that you can do. And I think that the regs do provide some limits on what people can invest. So I think if you make something like up to $107,000 or have a net worth of $107,000, you can invest $2,200 a year. But what I think it does is it gives an opportunity for people who really can't access private venture returns to put a little bit of money, and again, money that arguably these guardrails are in place to make sure it's not too much, to participate in this kind of asset class that they wouldn't normally be able to do. And I do think a lot of early stage companies do get overlooked by angel groups and VCs, and some of those ideas have merit. So I think with the controls, crowdfunding has some place in this ecosystem. Happy to provide the ninth opinion. Okay, how do we find you? How do entrepreneurs find you? Sandy, how do people find you?
A lot of there's 250 angel groups that are members of the Angel Capital Association out of the 400 functioning groups. And Gust is the most widely used platform. It can be a little quirky, but it does serve a purpose that the startup will put their slide deck, their information, their finances, and then angel groups will select some of those startups to screen. There was another platform called Proceeder. They've left this industry. There's a couple of new startups that are coming up, but the way startups find angels is usually through Gust or referrals from somebody they know.
Jason?
Oh yeah, I'm a big fan of Gust. Most of the HBS Angels chapters use that, but and we do get some organic deal flow through that. I mean, what we've tried to do in New York is we have 25 different investment sectors. And so we'll have 1 or 2 people that will lead that sector. So it ranges from fintech to cryptocurrency to cannabis. And so, we're a big group, so we at least have a couple of people in each area that are out actively scouting deals, trying to go to all the incubators, trying to network. And so that's a big source of deals for us. We'll get our sector leads involved both when a company applies to Gust to help screen it, but also our best deals are usually coming in from some kind of a member referral.
Most of the startups that wind up pitching the Westchester Angels have been referred by other angel groups that are already in due diligence or funding. And we've gotten really good deal flow. We've invested in 50% of the startups that have pitched in the last year and a half, and that's a pretty good percentage.
For me, I email Somak at armorsp.com. I always encourage people to reach out directly, but we do lean heavily on other referrals from especially angels and entrepreneurs. Our existing portfolio company, if you're in the food tech business and you have an interesting idea, you reach out to the handful of entrepreneurs we've backed, and that entrepreneur is vouching for you, that's a really good signal for us. But we also do respond to cold emails, and especially people from underprivileged backgrounds who don't necessarily have the networks necessarily. We want to pay it forward, but in general, if you have a LinkedIn, a mutual contact with any entrepreneur in our portfolio, that's a really good way to get our attention.
Great. All right, so I think we're getting ready to wrap up. Let me just ask one more question. I'm pretty sure we're going to have a recession. Certainly there's an economic decline. Let me maybe direct this one to you, Harris, first. How does sort of the looming change to the economic landscape affect how you're going to invest over the next 2 years?
I mean, our focus has always been on betting on people. And I think right now, with tough times coming, the real leaders are going to step up. So the founders that we were hoping we're finding before are just getting even more disciplined now. We have been looking at, as everybody has, hundreds of various pitches, and it's surprising me that a lot of the founders are not yet paying much attention to how can they be more careful with their money. We just kicked something off where we've been offering services to our founders instead of going out and hiring full-time C-suite people, why don't you outsource it a little bit until you're ready? So what's going to impact our investing is really the people. You know, I forgot who said it before, but just focusing on people that have fearlessness, because it's going to get tough. The last 5 years have been really easy for young founders to find money, and a $20 million company goes to a $500 million company, and none of the investors know why. So I think now it's getting back to the old-fashioned, like my dad taught me, roll up your sleeves and you better work. And we're exclusively focused on the founders and making sure we like them. We have a very professional rule in this office, which is no assholes. If we can't get along with the founders, we don't want you here. And I think that's going to kind of tee up even further, because it's going to get rough. And if I'm a founder right now, if I'm a good founder, I'm pretty excited, because I think the opportunities to raise money now will be better than ever if you have a good team and you're focused.
Yeah, I mean, I actually, we were very slow to deploy capital the last few years, and we were focusing on follow-ons for companies, but we were pretty slow. We've been waiting, I should have been saying for the last, I think, 3 years to all my CEOs who said, Somak, you're just crying wolf. I'm like, I'm telling you, things are going to turn around, and I guess I was right this particular year. But I think I agree completely with Harris that, like, I think there's been too much, there's a whole generation of entrepreneurs and even investors. There's so many investors who have never seen a downturn, who, you know, we have this thing in our industry called the J curve, right? Like the first few years, you have negative returns, and then you go up and up, right? If you're doing your job the right way. The last 2 years, I think another VC said it well, like, I think it was Jason Lunkin. A VC never saw a J curve, just went up and up and up. If you go to join a startup, it raises an up round, no matter how you do, right? So I think what I'm most excited about, I think it'll be much more difficult to raise capital, but I think it's a good thing. And I think you're gonna it helps, like, it was Warren Buffett who said that, you know, when the tide goes out, it's easier to tell who's swimming naked. It's gonna be a lot easier to see who really cares about building business, looking at the long term. And also, what I'm most excited about is the talent side, right? Really, honestly, like, you know, there's still a fierce war for talent, even as we're going through a market correction. But right now, you know, whereas some of my engineers and some of my portfolio companies at any given time had 5 offers from Google, Facebook, Amazon, now they've completely stopped. They're rescinding offers. So if you're an entrepreneur who can build a business and can really pitch a mission that's mission-oriented, you have a once-in-a-lifetime opportunity to build an amazing team. And I think those people who are staying with you are not just focusing on looking for the fancy up round, they're really passionate about your business. So it's getting, I think it's that part of growing a business I think is going to be is more exciting.
Anyone else? So I think as an angel investor, first, I don't want to minimize the pain that many people feel in a recession, because that certainly is true for lots of people. But I think as an angel investor, a recession is actually terrific news, because the market has gotten so overheated, and this gives us a chance to kind of see it brought back down to earth. And I don't think people quite realize some of the numbers. Actually, if you look at what's been reported through PitchBook, the funds deployed in venture doubled in 1 year from 2021, from 2020 to 2021. The VC numbers actually doubled, and 75% of all the funds raised in the venture class in last year were from non-traditional VCs. 75%. So that means only 25% is from people that have been really doing venture investing and focusing on it, like Somak. 75% is from Fidelity and family offices, from large pension funds that don't know anything about venture and are just jumping into the asset class right now. It's one of the reasons why early in 2022 and later last year we saw this massive increase in valuations and explosion in really lousy terms like safes that a lot of angel investors will try to avoid. And so with the recession, and you know, Professor Lerner at HBS would talk about a bubble and the characteristics of a bubble, and what ends up happening is that you've got all this money that comes in late in the cycle, piles in and gets the dregs of what other real investors don't want to pick up. That's what's been happening right now with valuations taking off, and because you can't deploy such funds completely in the late stage, you've got some of these later stage investors crowding down and moving more into the early stage, not to mention the impact of the crowdfunding bringing more people into the seed stage. And so a recession has posed the opportunity for all of these trends to be turned back, to let the money being deployed by people that really understand the asset class, let's valuations return back to normal. So I'm actually pretty excited about seeing the market cool off a bit.
Excited for a recession?
So from an angel group leader's point of view, it's going to be good and bad. The good thing is valuations should come down from their astronomical space that Jason spoke about a couple of years recently. But a lot of accredited investors this year may not be accredited next year. So angel groups may lose people just based on a definition. Investing money may be a little tighter because we never count other people's money, but families may need that money. Maybe you lose your job or something like that. So, and that's why we kind of plan for this, because nothing goes up forever. So that's why we're adding a tremendous social aspect to what we do to add value to the membership as compared to just writing checks out. So, listen, this is a natural occurrence. Nothing goes up forever, and we'll deal with it.
Well, since I am, I think, the last human being between you and the bar, I'll make this brief as I can. If I could time markets, if I knew the timing of markets, I wouldn't be a lawyer. They go up, they go down. I've always been a big believer in investing in all asset classes, including angel and venture, that you should be engaged in dollar average investing. In other words, you should never be out of the market by saying it's too high, too low. You should really be waiting for companies that fit your thesis, and if people, TAM, scalability, accountability, integrity, ability to pivot, you're seeing growth. If those things are there and they fit your thesis, you should be ready to act. And obviously, your ability to get the return you're looking 10x turns on pricing, so that factors into it as well.